Let us start with convertible securities and how the conversion would work. As I told you earlier, convertible debt will give you a right, or as a holder the right to convert it to a share in case if they likely to accept at a predetermined rate. So how does it work? Now let us look at this small example. This talks about a 10% convertible bond of a company which is quoted at pound 142 per $100 nominal. The earliest date for conversion is in 4 years time at the rate of 30 ordinary shares per £100 nominal. The share price is currently 4.15. Annual interest rate on the bonds has just been paid. The first thing is they are asking what is the current conversion value. So if you look at the current conversion value, you will understand that the current share price is 4.15. So what does this mean? Now if you have a $100 nominal $100 bond, you will be able to get how many shares? You are going to get 30 ordinary shares, right? So which means what your conversion value will be 30 into 4.15. So if you are having $100 bond, the current value is 124.50. Now what is the conversion premium? Conversion premium is, you will see, what is the market price? Market price of the bond is 142. So your conversion premium is $17.5. Now what does it mean? This means your share price will have to either rise by 14% or by 17.50 in total, right? So that means per share your 17.50 divided by 30, right? So your share price will have to go on up by that amount before the conversion rights become attractive to investors. Remember, when you say convertible bond, it is always the holder has the right. So if the holder is not willing to accept the convertible bond option or convert it to a share, what will he do? He can exercise the withdrawing of money. So he has the right to take money back. So to ensure that company, why the conversion was given by the company is to ensure that they don't have the burden of finding cash at the maturity of the bond to repay the bond. So which means now when you have a share price lower than the value of the bond, it's obvious that the bond holder will be going for the repayment of the bond rather than going and taking the share or accepting the share. Now it is also important for us to understand what is going to be the issue price and the market price of convertible bonds are. Now let us learn this through an example. Now CD has issued 50,000 units of convertible bonds and generally each with a nominal value of $100. Remember, all the bonds are generally issued, bonds and debentures and loans all are issued with a nominal value of $100 and a coupon rate of interest of 10% payable yearly. Each dollar 100% of convertible bonds may be converted into 40 ordinary shares of CD in 3 years' time. Any bonds not converted will be redeemed at 110. So which means if you are not satisfied with the return you are getting by converting, you will not be opting for that. So you can redeem it at $110. Estimate the likely current market price of $100 of the bonds. If investors in the bonds now require a pre-tax return of only 8% and the expected value of the CD ordinary shares on the conversion day is two scenarios being given. One is $2.5 per share and B is $3 per share. So let us assume you go with the current market price of $250 per share. Now your conversion ratio is you will get 40 shares for a $100 bond. So what does this mean? On the conversion day, what is the market value of your bond? It's only 250 is the share price. If you convert this, if you accept this offer, the share price is 250 and you get only 40 shares. So which means the value will be 100. But if you redeem it, if you redeem the bond, how much can you get? You are entitled to get 110. So which means your market price, what you will do is, what will be a rational investor will be doing? As a rational investor, you will be taking it at 110 rather than at 100. So you can find your bond value because what are the cash flows associated with the bond? You have the interest of 10 for 3 years and at the end of the 3 year you will have the redemption value of 110. So you will discount it at the discount factor of 8%, which is the normal present value technique, and the cumulative value of the all the present value or the net present value of the investment is what you call the price of the bond, so which we'll call 113.11. So this is a flow value for somebody to sell the share. And so if your shares are valued at $3 each, then which means that will give you $120. So instead of you redeeming the debt at 110, what will you opt for? You will go and convert this to a share, so because you will get 120. So what you will do is, here you will place it with 120 and find a value, so which will give you a different bond value. So what you will understand here is, so the bond value will depend on the current market value, and the fact that whether you a person or an investor will convert the share or not will depend on the current market value of the bond. And what are the advantages of convertibles? Remember, there are a number of advantages with convertibles. One is it serves as a sweetener for debt, because the moment that uh, this convertible option is attached, investor will be able to participate in increases in price of share capital, and also issuer can pay a lower interest because of this. And the attractions of the conversion rights, the possibility of a significant capital gain, and also it will be a hedge against the risk of the risk of having the responsibility of paying the debt back. So convertible may provide a means of issuing equity ultimately at a higher price than the current market price. So because what you do is, today if you issue a share, let's say you issue your share price may be $1, but if you convert it at 250 or $3 later on, which means it is at a higher price, so your financial requirement is also being met while issuing the share at a higher price for the future. So there may be provisions in the issue terms allowing the issuer to force conversion if the market price of the bond is greater than the conversion price. Now some bond issuances do does is, they carry the provisions to force a conversion if the price is high, because now we always told that it is a right but not the obligation of the person who subscribe to the convertible bond, but there may be terms which would carry for forced conversion. And if the conversion issued straight bonds initially and then equity to redeem the bonds, what will happen is there will be two issue costs, and the whereas for a convertible bond you will have to pay only once, and the debt ratio is reduced if the conversion takes place. So you have an impact on your gearing as well when the debt is converted. What are the disadvantages? Now, if the converter had waited for funds and the market prices increases significantly above, the company misses the opportunity, because had they issued shares at that particular point, at the point of conversion, they could have raised a greater capital. The company has to repay the debt if the share price does not increase. That is another issue. Some borrowers will be reluctant to invest because of the lower yield on convertible shares, because the problem that you have is, although you say that you pay a lower interest because of the sweetener, what happens if the share prices doesn't go up? If the share prices doesn't go up, then the borrowers will be in trouble. Rather, the lenders may be in trouble, so because they may not be having a potential return that would be required by them. And as compared with warrants, the exercise of convertibles does not provide extra funds to the firm, whereas warrants does, because warrants is you agree at a pre-agreed share price, whereas a convertible bond, the price is converted and all the amount that you have to pay has already been paid to the company, and there will be no cash flow for the company. Now when you borrow, there is also a requirement for you to understand what kind of securities that we lend. Now there are two types of security borrowings that we do. One is the fixed charge borrowing and the other one is the floating charge borrowing. Now, what is a fixed charge? Fixed charge is security relates to specific assets or group of assets. For example, you will say a debenture or fixed charge over the land and buildings. So debenture will be secured over fixed charge over the land and buildings of the business. Now, you cannot dispose of any of these assets either without the consent of the lender or without providing a substitute. On the other hand, there is floating charge debt. Now, floating charge debt is a security in the event of default. So, whatever the assets of the class secured, merely inventory or trade receivables, the company at that time on. So, it's a floating charge. Now, company can dispose of assets until default take place. In event of default, lenders appoint receiver rather than uh, lay claim to the asset. So what will happen is basically in a floating charge the company has the ownership of assets and the conversion rights of the assets until the company is performing. So the moment company is default, then the receiver will need to be appointed. Now, when it comes to redemption of long-term bonds, it is important how will a company finance the redemption of a long-term debt, because generally what will happen is when in most of the long-term debts when you are borrowed through bonds, it is prepaid at maturity. So the entire capital repayment will need to be matched and financed. So the finding this, how the method, what are the methods that is available is very important. And what are the other types of instruments that you can issue on for debt? One is bank loan and the other one is a cooperative. So these are the instruments that we talked all throughout, right? And how you will need to apply this and is very important. So with this we have concluded long-term debt finance area, and in the next chapter we will start with talking about the cost of capital, and we will move on from there on.